Picture this. In less than 7 weeks, nearly 38 million ounces of silver just disappeared from exchange warehouses. To put that in perspective, this is the fastest depletion we've seen in over 4 decades. But here's where it gets interesting. The last time we witnessed something like this, silver rocketed to nearly $50 an ounce, and the entire commodities trading system almost imploded. Fast forward to now. We're seeing something that defies basic economics. The price to buy silver right now, not next month, not next year, but today, is actually higher than the price for future delivery. When that happens, it's usually a sign that someone's desperate. This isn't just another market rally. What we're looking at is a repeating historical cycle that's unfolded multiple times throughout modern financial history. And if the pattern holds, we're approaching a point where price becomes irrelevant, because there simply won't be any silver available to purchase. I'm going to walk you through exactly what's happening, why this time might be different, and what a legendary trading disaster from the 1980s can teach us about navigating what comes next. The cycle explained throughout monetary history. There's a recurring pattern with 4 distinct phases. Once you understand this framework, what's happening right now becomes crystal clear. Phase 1. The foundation. It starts when a physical commodity becomes the backbone of currency. Governments tie their money supply to it. Prices remain steady for generations. Citizens build trust in the system. Silver fit this role perfectly for over a century and a half. Until the mid-1960s, American pocket change contained actual silver. You could exchange paper currency for the metal directly from financial institutions. The system was stable, transparent, and reliable. Phase 2. The abstraction. Eventually, someone figures out that paper claims are more profitable than physical storage. 1 real ounce gets leveraged into 10 derivative contracts, then 50, then 100 or more. These paper instruments flood the market, creating an illusion of abundant supply. Prices soften because it appears there's endless availability. But that abundance is fictional. It only exists on balance sheets. Phase 3. The reckoning. Demand increases. More people start requesting actual delivery instead of settling for cash. The warehouses start emptying. Then comes the collective realization. There aren't nearly enough physical ounces to satisfy all those paper promises. This triggers a rush. Everyone tries converting their paper claims to metal simultaneously. But the metal isn't there. Phase 4. The collapse. The derivative market breaks down entirely. Exchanges suspend trading. Deliveries fail in a domino effect. Physical metal prices explode while paper contracts become essentially worthless. Those holding real metal come out ahead. Everyone else learns a harsh lesson about the difference between owning an asset and owning a promise of an asset. This is why price becomes meaningless in the final phase. When the paper system collapses, there's no synthetic price, only physical transactions. And using data directly from commodity exchanges, I can demonstrate we're already well into the 3rd phase. Why silver is unique. Before we go further, you need to understand what makes silver fundamentally different from every other traded commodity. Gold is primarily a monetary metal. Silver plays a dual role. Yes, it's a monetary metal with thousands of years of history, but it's also the most irreplaceable industrial material in our modern world. Open your smartphone, there's silver inside. Solar panel technology depends on silver. Vehicle electronics, silver. Medical devices, silver. Next-generation wireless infrastructure, silver. Defense systems, silver. Virtually every technology that defines contemporary civilization has silver as a critical component, and we're burning through it faster than we can mine it. Last year alone, the deficit hit nearly 149 million ounces. That's the 4th consecutive year of deficits. Mine production is declining. Industrial consumption is accelerating. Research from Australian universities suggests that just the solar industry could consume between 85% and 98% of all available silver reserves within the next 25 years. Now watch what happens when we apply this historical pattern to current market conditions. The Hunt brothers' story. First, let me prove this pattern is real by examining the most dramatic example ever recorded. 2 oil heirs from Texas, Nelson Bunker Hunt and William Herbert Hunt, decided in the late 1970s that fiat currency was doomed. Inflation was running at 13% annually. The gold standard had been abandoned. They believed silver represented real wealth. So they started accumulating, not modestly, aggressively. Eventually, they controlled roughly 200 million ounces, half in physical possession, half through futures markets. Their timing seemed perfect. In early 1979, silver traded around $6. By autumn, it hit 10. By year's end, 30. On January 17, 1980, silver peaked at $49.45. That's more than a seven-fold increase in 12 months. The Hunt brothers were suddenly among the wealthiest people in America. But Wall Street was panicking. Why? Because the Hunts weren't just speculating. They were taking physical delivery, draining actual metal from vaults. And they were using massive leverage through futures, controlling far more silver than they could have purchased outright. Every futures contract they held represented a claim on real metal. And they kept demanding that metal be delivered. The exchange was terrified. If this continued, the entire system would fail. So the exchange did what exchanges do when they're losing. They changed the rules mid-game. In early January 1980, they implemented Silver Rule 7. No new long positions allowed. You could sell. You could maintain existing positions, but you couldn't buy. Translation: they were freezing out the Hunt brothers. Silver kept climbing anyway. Then margin requirements got drastically increased overnight. Suddenly, holding these positions required hundreds of millions in additional capital. The Hunts scrambled, they started selling, others panicked and followed. March 27, 1980. Silver Thursday. The price collapsed from $21 to $10.80 in a single trading session. The Hunt brothers lost $1.7 billion. They filed for bankruptcy. Brokerage firms teetered on the edge. Banks froze credit markets for 48 hours. The entire financial system nearly broke. But here's the critical detail everyone overlooks. The people who owned physical silver, not futures contracts, not paper derivatives, but actual metal in their possession, they didn't lose anything. When the chaos settled, silver was trading at $10. That's still 66% higher than the starting point. Those who bought physical at $6 and held through the turbulence made substantial returns. The Hunt brothers failed because they used leverage and paper instruments. The system changed the rules against them. But you can't retroactively change rules on something you physically control. This lesson matters because we're watching the exact same setup develop today. Only this time it's potentially more severe. Historical parallels. Remember 1971? When President Nixon closed the gold window? Foreign governments were demanding physical gold in exchange for dollars. The United States didn't have enough to meet those claims. So Nixon simply ended dollar convertibility to gold. Over the next decade, gold went from $35 to $850. Silver rose from $1.40 to $49. Both metals were telling the same story. When you remove physical backing from currency, paper loses value, and physical assets explode in price. The same pattern destroyed traders in palladium markets in 2001. Russia controlled 60% of global supply and mysteriously delayed shipments. Physical metal vanished. Prices spiked 263% over 2 years. Traders holding paper contracts got crushed when there was no metal available for delivery. People holding physical palladium became extraordinarily wealthy. 3 separate examples. Same pattern, same outcome. Physical metal wins. Paper instruments lose. Where we are now. So where does silver stand right now? Let me walk through this using data released just this week. Phase 1. Complete. For over 150 years, silver functioned as money. U.S. coins contained 90% silver content until 1965. You could exchange paper dollars for silver at face value through banks. Then in 1965, silver was removed from coinage because the metal became worth more than the coin's face value. That should have been the warning sign. The market was valuing silver higher than the government's price. Instead, silver got reclassified as merely an industrial commodity. Once silver lost its monetary status, Wall Street built the paper market. Futures contracts, exchange-traded funds, certificates, derivatives. For every physical ounce, they created 50 or sometimes 100 paper claims. The largest silver ETF claims to hold 440 million ounces. But read the prospectus carefully. They reserve the right to settle in cash if physical delivery isn't available. Your silver might just be a promise to pay you money if silver appreciates, not actual metal. The Commodity Exchange reports total vault holdings of 265 million ounces, but only 43 million ounces are registered for delivery. When futures traders demand physical settlement, there are only 43 million ounces available to cover hundreds of millions in outstanding contracts. See the problem? For decades, this worked fine. Most traders closed positions for cash. Industrial users got their metal. Banks collected fees. Until now. Phase 3. Active right now. On October 1, 2024, the exchange reported 80 million registered ounces. By December 3, 2025, that had dropped to 43 million. This isn't normal profit-taking, this is a run on the vaults. And it's accelerating. On November 17th alone, over 6 million ounces were withdrawn in a single day. Then on February 14th, 2025, 4 major South Korean banks simultaneously suspended silver sales. Not temporarily, indefinitely. These are institutions with unlimited capital and global connections. If they can't source silver, what does that tell you about actual availability? China raised risk classifications on precious metals. Citizens literally cannot purchase through banks anymore. Why? Because China is accumulating for state reserves. They've restricted exports. They now require physical deposits for futures trading. They're preparing for something. India's silver imports hit record levels in 2024. Indians have experienced currency crises. They understand that physical metals protect wealth when paper fails. Now add industrial demand. Solar panels consume 12% of annual silver supply. Electric vehicles use twice as much silver as traditional cars. Next-generation wireless infrastructure. Artificial intelligence data centers. Every major technological trend increases silver consumption. Meanwhile, mine production has been declining since 2016. Recycling can't keep pace. The deficit hit 148.9 million ounces in 2024, with projections of 117.6 million for 2025. And now investors are waking up. Silver ETF inflows have surged. Retail purchasing is at levels not seen since 2011. Online dealers report inventory shortages and premiums above spot price rising. When you're paying $5 over spot just to obtain physical metal, the paper price is misleading. And then there's backwardation. Spot price is higher than futures. This screams physical desperation. Futures should trade at a premium due to storage costs and time value. When spot trades higher, people are paying premiums for immediate delivery over future promises. We are deep in Phase 3. The squeeze is active. Phase 4. At the threshold. In November 2025, the exchange experienced a trading halt. Official explanation: cooling system failure. A cooling system failure in market infrastructure designed to military-grade specifications handling trillions in daily trades. Experienced traders know that when exchanges halt trading during price spikes, someone major is in trouble. The exchange faces 2 options: change the rules like they did in 1980, raise margins, restrict positions, suspend deliveries, or let the market run and watch prices go parabolic. What do you think they'll choose? They'll attempt to control it, but here's the critical difference. This isn't 2 Texas billionaires. This is global demand. Industrial users who need silver for production. Investors across dozens of countries. Central banks accumulating reserves. BRICS nations building alternative financial systems. You can't impose rule changes on everyone simultaneously. When Phase 4 fully arrives, trading halts become routine. Delivery failures cascade. Contracts get cash settled against holders' wishes. Premiums explode. Spot might be $60 while physical dealers charge $80, $90, $100 just to obtain metal. Then one day, the paper market freezes completely. Contracts suspended, lawsuits filed, regulators investigate, and people holding physical silver observe from safety because they already won. What to do? This isn't speculation. This is pattern recognition, and the pattern is unmistakable. Here's how to position yourself. First, understand the distinction between ownership and speculation. Trading paper for quick profits, that's speculation. Understand those risks. But acquiring physical silver is protection, store of value, insurance against monetary system failure. And there's only one legitimate option: physical metal in your direct possession. Not in a vault you don't control, not in an ETF, not in futures contracts, in your hands, in your safe, where you can see it, touch it, and secure it. That's ownership. Second, acquire now while premiums remain reasonable. Physical silver is available today at $3 to $5 over spot. When the squeeze intensifies, premiums will jump to $20, $30, $50 over spot. Eventually, none will be available at any premium. Dealers sold out. Mints with year-long waiting lists. You'll be standing there with depreciating cash, unable to convert it to the one asset gaining value. Third, focus on recognizable liquid forms. Silver coins from government mints. Silver bars from major refineries. Avoid collectibles, avoid numismatics, avoid fancy premium products. You want pure silver content in forms anyone, anywhere recognizes. American silver eagles, Canadian maple leafs, standard bars from established refiners. Fourth, scale appropriately. This isn't about betting everything. This is about allocation. Take 10, 15, maybe 20% of assets and convert to physical silver. Enough that if the pattern completes, you're protected. But not so much that if something unexpected happens, you're destroyed. Balance caution with action. Fifth, store properly. Home safe. Bank safety deposit box if you trust the institution. Private vault if you prefer. Ensure you control access. No third-party custody where someone else holds the keys. The entire point is eliminating counterparty risk. Don't reintroduce it through poor storage decisions. The window is narrowing. Not because of hype, not because someone's promoting it, but because the vaults are emptying. Banks are stepping back. Backwardation is screaming that physical supply is disappearing. The market is broadcasting the truth. You just need to listen. Every fiat currency in history has eventually failed. Every single one. The average lifespan is 27 years. The US dollar has been fully fiat since 1971. That's 54 years. We're on borrowed time. And you cannot print silver. You cannot create it through monetary policy. You cannot algorithm your way out of a physical supply deficit. Physics doesn't negotiate with economic models. So here's my question for you. Are you going to wait until the system breaks and regret not acting? Or will you recognize the pattern, trust the data, and take action while there's still opportunity? The choice is yours. But windows don't stay open indefinitely. If this analysis resonated with you, if you see the pattern emerging, subscribe now. Because what I've shown you today is just the surface. The silver paper market collapse is one symptom of a much larger systemic failure that's unfolding across multiple markets. In the next video, I'll reveal how deep this goes. The currency crisis, the debt spiral, the derivatives time bomb, all following the same four-phase pattern, all headed toward the same inevitable conclusion.